Good afternoon, YouTube. Welcome back to Stocks by the Numbers. And of course, I wanted to do a quick update video on a company that we spoke about that I know a lot of people were hyped about. Again, the stock's trading under $5 a share, been around for a while, pay you a dividend to own it. Name of the company, Nokia Corporation, ticker symbol NOK, listed here on the New York Stock Exchange. Now, this circle right here is where I made the video. As you see, March 30th, we looked at the numbers, we looked at the chart. I said I liked it. And of course, the stock went up a little bit and then boom, completely started cratering down going into earnings. And if we look at numbers here, you can see a slight beat on the revenue side and of course a big miss on the EPS side. Supposedly they were citing like a little belt tightening in customer spending and whatnot. So obviously Wall Street did not like to hear that, and they immediately started to chunk the stock down. Now again, this is where they reported earnings on 4/20. Hello. And here you can see they've been bouncing it down and around, and unfortunately we are forming a downward trumpet, which again, this trumpet pattern is not really definitive of a bullish move or a bearish move, so we kind of just have to wait and see what's going on here. However, right around here at this level, like this 395, 396 level, I drew out a trend line and then extended it over here to the left. And you can see going back, look at this. This is a tail end of 2020, beginning of 2021. And you can see, look, I drew this ellipse here, and you can see multiple bounces of resistance and support right there at that level. This is right where it closed here. Look at this, going back to May, June of 2020. It closed right at this level it's currently at, and then boom, it had a gap up. And before that, you can see multiple bounces of support and resistance right here around this level. And we can just extend it. We can go all the way back. That blue line's still there, don't worry about it. Boom. And now here we are. Look, we come back to 2013, and you can still see. Look at that. Look at all the bouncing. Look at all the bouncing happening at, again, this is the current level that the stock is currently trading at, right below $4. Multiple bounces. So, of course, I mean, can it go lower? Well, of course. But, remember, they have been beating up telecom companies. We've been discussing in the Discord some short-term plays on Verizon, because in my opinion, Verizon has been beaten up a lot as well. So these telecoms are struggling. Obviously, they're getting hit with a lot of these costs, increases in operating expenses, cost of goods sold, and obviously that's eating away at the profitability. So they've basically been beating up these stocks. But you can see, look at this, we're going back to December of 97. You can see the bounce right there at that level. Going into early 97, again, multiple bounces here at this level. And this is, we're basically at inception, yeah. So look, even all the way back here to 95, you can see this is a very, very key level. So obviously we kind of have to wait and see what's going to happen here. And I also wanted to show you, if we take the auto off, right? So this is our downward trumpet, and let's just say hypothetically, worst case scenario, we break this trend line, right? If we come down to the middle of the trumpet, let's say, and it just stays in this range and never recovers, as you see, middle of the trumpet, you're looking at about like 360 and change. So, unfortunately, we still do have the potential to drop in the short term. And, of course, this long existing trend line and this top trend line of this trumpet is, that is actually forming a little descending triangle. So, if this stock like bounces off this line now and just kind of like stays in this tight little range, you're probably going to have to expect a drop. It's looking like middle of June, so probably about 2.5 weeks. You're going to have a potential drop there with the descending triangle setting up in the shorter term since earnings, and then that's what I mean. That'll justify it even more for it to come down. However, last time when we initially looked at the stock, we looked at a lot of the numbers, and in my opinion, it did look very attractive. So that's why, again, these are the good things with buying some of these companies, because, of course, it was up here, now it's down here. Yeah, it sucks. I get it. But also at the same time, a lot of analysts even came out here around April 20th when the company reported earnings. And I think it was Deutsche Bank, maybe. I can't recall right now, but I remember I read an article right before I started recording the video. And, yeah, that guy basically said, he's like, hey, listen, the company still looks healthy. And, It looked good before they posted earnings. And now they posted earnings and Wall Street brought them down. So, we feel at the firm this is like a phenomenal entry point. And I have to say I agree with him, right? Because it always goes back to what we say. If we were piecing into this stock 440, 450, 470 for the long-term portfolio, of course, and then boom, you wake up and it's like, all right, EPS was light, but the company still brought in like healthy revenue, and you're chunking the stock down. Yeah, I'll take it in stride, absolutely. Especially if it's more of a long-term play as opposed to a short-term play. If you stepped in here or you bought calls or you went all in hoping for a pop on earnings and then something like this happened, obviously I can appreciate the fact you're kind of upset with the situation here. And that's why I say it is much, much easier to invest for the long term as opposed to trading in the short term, especially in this market. I will say that, especially in this market under this administration. And I know I constantly keep bringing that up. I even mentioned it a couple of times in the Discord, and I'm sure people may be tired of hearing it. But I will say this. Under Trump, companies were trading at more realistic values. So as much as you might disagree with an analysis I might do on something like a Palantir or an Nvidia, saying that they're overvalued, they should come down, and then we switch over to a company like a Nokia or a Verizon, and we look at the numbers and say they should be trending upwards. Let me tell you something. Under Trump administration, what I was saying was happening, and overvalued companies would fall down, sell off, come back down to earth, and undervalued companies that were oversold, undervalued, trading with low PEs, they would all climb back up to earth to where they should be trading at fair value. That's why I mentioned to you guys a couple of times, under Trump, I was absolutely killing it, especially on the short-term option side, because once a week or once every other week, I would just pull up a list of the Dow components. And you just look at what's been selling off the last week or two, what PE is now down at like 9 or 12 when the rest of the industry is trading at like 15, 17, 19 PEs, and you would just load it and say, all right, I'll buy some calls on this undervalued stock for a couple of weeks out, and guess what? All of a sudden, the son of a bitch starts rallying, and your options are up 100%, 150%, 350%, and you feel like a champion and you look like a genius. But all you did was look for brand name companies that pull back, that you could have gotten in at a discount. And again, I have to say that's basically what we're seeing here. I mean, I know some people might want to dissect some numbers and kind of just beat this company up. But again, we have a market cap a touch over $22 billion. We're getting paid 1.7% yield to own shares of the stock. They're trading 5 times earnings, which is embarrassing, right? It should be at least double that, in my opinion, which of course would bring the stock to $8. But even switching over here, look quarterly. I mean, had a breakout quarter there in Q4 of 22, and then obviously you see the line pull back there. That's the profit margin, that orange line that they're showing, and you can see, revenue, income, everything dipped down going from Q4 of 22 to Q1 of 23. But what a lot of people aren't realizing is, check this out. They brought in revenue $6.29 billion for Q1 of 23, right? Net income, we'll call it $300 million. Profit margin, 4.75%, right? Keep those numbers in mind. Now we go back 1 year prior. $6 billion, $237 million net income. Profit margin, sub 4%. Excuse me. So revenue went from $6 billion to $6.3 billion, period, 1 year ago, right? That's 5% increase. Income was $237 million, less than 4%. Now $300 million, almost 5%. So that profit margin increase from 3.96% up to 4.76%, that's like a 20% increase. So again, 1/5 higher, right? So revenue's up 5% year over year. Income, which again is profitability off of every dollar brought in from the revenue side, is up over 20% more than where it was this same time last year. So, the company, they might say is dealing with some hiccups and some speed bumps, but if you really look at it, they have been maintaining, again, we looked at this last time, you had the slight dip down to sub 25 billion in 2020, but this entire time, the company has not only been maintaining roughly this $26 billion mark, but look at the profit margins, going from negative 1.5% back in 2018 up to flat. Of course, we know what happened in 2020. And then look at this, in 21, 7.3. And for 22, 17% profit margin. So a couple of years ago, you were flat, negative. If 2020 didn't happen, profit margin probably would have been like 3.5% to 4%, right? So they would have went from slightly negative to flat to slightly positive to doubling the positivity to more than doubling the positivity, almost 150% increase in profit margin from 21 to 22, still the whole time maintaining that $26 billion mark. So again, they're bringing in $26 billion for the year. The company has a market cap of $22 billion. Now just remember, anyone who will potentially bet against this company saying that, oh, you're just using simple logic and common sense, looking at a couple of numbers, you can't look at a stock like that. Well, first of all, of course we can, right? Because I always say simple logic and common sense trumps all, no matter what these people say. But on the flip side also, you can spin this back. We saw what happened with NVIDIA today. The company beat earnings. They brought in, a little over $8 billion, and now they're bringing the valuation to, quote, $1 trillion company. So if you make $8 billion in the quarter, you're worth $1 trillion apparently, right? So if we go back and we look at the numbers on NVIDIA, they're bringing in $30 billion for the year, and their market cap is $1 trillion, right? So notice it's only specific, widely held tech companies like your Teslas, your AMDs, your NVIDIAs. See, those are allowed to trade 30, 50 times yearly revenue, right? But when you use that same logic with every other company across the board, all of a sudden everyone wants to butt heads with you. And just remember, if Nokia decided to trade at the multiple that NVIDIA is currently trading at, then that means this stock is going from sub 4 to $100. Right? So, I don't know. Blow it up maybe? I don't know. No, I'm just kidding. Just trying to make a point. But overall, in my opinion, I do like Nokia. However, as I keep saying, just like when the people on Wall Street Bets were simply just putting out a list of stocks with high short interest and just telling everyone, the same thing like GameStop's going to happen, just pile in, make the short squeeze. You have to understand, they bring stocks down for a reason, okay? And if you don't understand the why, you will probably, in my opinion, never be successful. So you have to look at the why. Again, whether you may agree with it or not, you have to look at the why, right? Profitability went down last quarter like we looked at. EPS came in, 15, 16% on their estimates. Yeah, that's kind of dismal. We don't like that, so we're telling all of our clients to sell the stock. Okay, I may not personally agree with it because I still feel the stock is undervalued. However, now I have a why, right? And now we can try to predict, okay, for the next 30, 45, 60 days, the company is going to be down or flat, and then potentially going into next quarter's earnings, we can jump in at the lows of the range, potentially catch a small rally going into earnings, and then, God willing, everything works out, the company posts healthy numbers, and then boom, the stock jumps from, this $4 level back up to like $4.40, $4.50, and gets back into that long-term pattern that it was currently trading in. But if you do look at some of these numbers, it is understandable. It really is. If you look at the mobile networks, obviously they've taken hits over the last couple of years. Of course, the company is branching out into some other things. But even if you look at the cloud networking services, you can see slight decrease from 21 to 22. Nokia Technologies, it was significantly higher several years ago. And now going from 176 down to 166, right? So you have some negatives that you cannot completely sweep underneath the rug just because, they made, 25, 26 billion, they're only worth 23 billion, it's undervalued. Sometimes it is good to look at it that way, but again, it really depends how healthy a lot of these fundamental metrics look on paper as well. That's why I always talk about the perfect storm, right? When, 98% of all fundamental metrics look phenomenal, and then you do your yearly revenue to market cap comparison and it's not adding up, and you have a stock with a PE of like 5 or 7, and then we check over here stock charts, right? Because you have to check that as well, and then you switch over to stock charts and you see that it's, stably bouncing off a moving average or about to climb up and break out to the top of the Bollinger Band range or something like that. That's when I talk about the perfect storm, right? The fundamentals are lining up, the stock is undervalued on paper, the technicals also look good, it's setting up a bullish pattern, and you switch over to stock charts and you see the MACD crossing, trending upward, right? That's the perfect storm, where you can literally ramble off 18, 19 positives, both fundamentally and technically, as to why the stock is going to go up, and maybe you'll have your 1 or 2 negative metrics that could hinder the stock. But again, when the positives heavily outweigh the negatives, that's really when you know you have a winner on your hands. And right now, again, I do feel they've beaten this up a little bit, especially if we go back here again. You can see, look at them coming in above estimates here on the profitability side, right? So that's what I mean. That's why it's interesting. This is why, in my opinion, I view this as a buying opportunity, not necessarily a negative. Because supposedly, again, they beat the stock up. Why? Because EPS, also known as profitability per share, was lower than what Wall Street was anticipating. However, if we look at the history of the company, they have not missed the annual EPS estimates going all the way back from 2016. So we got 7 beats in a row. They posted 48 cents per share last year off estimates of 42. Now for this year, estimates are only 44. So again, like I said last time, if the company just maintains this profitability, they will beat estimates for 2023, again, making it 8 years in a row, and then be in line in 2024. However, chances are we can probably make the assumption that this number is probably going to increase year over year, because again, when we went back and looked at this, we see slow and steady profitability growth over the years, right? So again, this is why I always say it is much, much more difficult to try to time a bounce or a drop, a pop or a drop in the short term, as opposed to simply breaking down the entire situation and saying to yourself, okay, I'm going to piece my way in here at 440, 450 going into earnings, and then I'll see how the numbers come out. Oh, the numbers came out light. They beat it up. They brought it down 10%. Okay, I'm going to step in. I'm going to start piecing my way in more down here at the low 4s and the very high 3s, right? So you never just load up all at once. So I know I'm throwing a lot of things at you guys, but I'm sure you can appreciate what I'm saying. But again, we're trending downward here. We are in this trumpet pattern. So we have to see over the next couple of days, the next week or so, if it does really hold this trend line and bounce around and try to rebound and break out of this trumpet. If it begins to drop down and it closes at like 391, 387 and whatnot, then yeah, chances are they're going to continue to bring it down. As I said, middle of the trumpet perhaps going into earnings. Next earnings report slated for July 20th. So they just reported earnings a month ago, so now you have 2 months till next quarter's earnings. But again, in my opinion, it should stably bounce off this level and could even potentially climb back up into this long-term symmetrical triangle that we spoke about. However, again, if they want to beat it up, let them beat it up, because chances are, if you are watching the video, you are most likely, in my opinion, you should be anyway, involved into this company for the long term, not the short term. And in the long term, it still does look pretty good, in my opinion. Got to throw my auto back on. So again, you're looking at the technicals. This is the middle of our trumpet here. I know it's hard to tell, but you're looking for the breakout. You're looking for the pop-up there on next quarter's earnings to potentially even get you back into the symmetrical triangle. And then as you see, that's going to be like the tail end of the summer. And, hopefully it will pop up out of the triangle instead of breaking down, because you really don't want it to drop to 285 again. But I seriously doubt that's going to happen. But again, that's just my opinion. But I really do believe it should break up here and see climbing into like the high 6s and the 7s. It really should, in my opinion, be reapproaching this top trend line. And I know it might take a while. It might take 3, 6, 8 months. But in my opinion, it really should. And again, I know it's down, whatever, 10, 12% from when I made the video. Earnings came in, a little light on the profitability. But again, if you look at the big picture, the broader picture of how the company has been performing, I will still say, in my opinion, that it is undervalued. But I did want to check these financials here just to reiterate again. Look at the assets. You know, they were up to about 50 billion. They dropped down about 10% from there, but have been slowly climbing, as we see here, back up to about 48.75 billion. And the liabilities, it was up to 31 billion at multiple times. You know, it was decreasing, as we see here, 17, 18, 19, and then of course 2020. We know what happened. So liabilities went back up, but as you see here, look, going from above 31 billion down to 28.6, now sub 26 billion, right? So assets reclimbing, liabilities decreasing. These are all good things. These are all good things. Holding a couple of billion debt on the balance sheet, definitely not a red flag in my opinion. Book value 408, right? So think about this. You can buy shares right now for $3.96, hold them. The company has to close its doors, liquidate everything in their name, pay that money back out to shareholders. Guess what? You're making 12 cents a share if the company liquidates everything right now. So that, you know, that's why on paper the company is worth $4 a share. But if we go and look at all of the other companies that are performing well, some of them are trading, you know, 5, 7, 15 times book value or whatever. So how about 2 times book value, right? That's fair. I think that's fair. That's in line. Guess what? 2 times book value, $8 a share. Little feather in your cap there. And you switch over here again, look at this, just steadily maintaining. If you take out 2020, this company has been maintaining $26 billion a year in annual revenue, going all the way back every single year since 2016. Let me tell you something, nothing to sneeze at. More importantly, look at the cost of goods, approaching almost 18 billion, slowly pulling back. Now it's sitting at 15.25 billion for last year, 2022. And the profit obviously increased again. Revenue minus cost of goods yields gross profit. So the profit has been increasing, which, of course, we looked at the profit margins earlier. And same thing with the operating expenses. Was above $8 billion for 3 years in a row. And then they got it down to sub 7. Now it's back up to 7.9. But it's still not the highest it was. So they're lowering the expenses and increasing the profitability while maintaining annual revenue. You know, I'm sorry, you can call me crazy if you want, but that doesn't sound too negative to me. I think that sounds extremely positive. And with all of the uncertainty and volatility happening with these companies' numbers, with what they're reporting and what estimates are, what people are expecting, and then the massive pops and drops in the stock, I mean, it's good to see some stability. It really is. Negative here on the cash flow as we looked at. Cash from operating activities took a big drop here, about half. So that's why I'm saying it's like there are some positives here, there are some negatives. But overall, I will say I do like the company in the long term here. PE of 5, lowest it's been, going all the way back to 2016. Trading sub 1 price to sales. It was only below that at one other time, going all the way back to 2016. Price to cash flow has increased to above 22 times cash flow. However, not the highest, not the lowest it's been, so not necessarily the best metric. Price to book, 0.95. We looked at it before. Stock right now, $3.96 a share. Book value, 408. This is the lowest price to book ratio the company has had on record for the year, going all the way back to 2016. The enterprise value, as we said, random motorcycle going by, enterprise value, as we said, moves, you know, it's supposed to be the value of the company that another company would pay to buy them out. However, we see with companies like Palantir, it does move with overinflated stock price as well. So definitely not the main metric to use there. But if we switch over here, look at the return on assets, as we see, climbing very well with the return on equity and the return on invested capital. Look at the gross margin percentage that we looked at before. Again, took a hit here as of right now currently. However, the company again did say in last quarter's earnings that they're expecting a very healthy second half to the year. So if we just like block out what's currently happening here, you can see consistent. Obviously, it had a pullback here from 35 to the low 30s, but then as you see, 32 up to 37, up to almost 41, up to almost 42, right? So all of these numbers seem to be consistently increasing. Same thing here at the operating margin. A couple of percentage points, gets above 5, almost 10, over 11, right? A lot of these numbers are trending in the right direction. But as of late, because they may have headed in the opposite direction, that is what Wall Street is going to justify as a warranted sell-off, if you will. And the EBITDA, once again, earnings before interest, taxes, depreciation, amortization, has been bouncing around, was high single digits up to double digits, back down, and then 13, almost 15, almost 16, higher, almost 16 again. So this is why I'm saying you can't knock the company. And again, over the years, fought to go positive on the net margin, pulled back negative double digits, and has since jumped from 7%, almost 17%. So looking at the company as a whole, again, we would need the next couple of quarters to come out to really reanalyze this year compared to this last year. However, again, looking at where they've come from and where they are now, the company is definitely trending in the right direction. But of course, there are other metrics as well, right? We've been looking at the inventory turnover, as you see, consistently decreasing. Was up to the high 5, 7, and just slowly been pulling back here, jumped up to 5, 6, and now sub 5. Asset turnover, which is technically, again, can be used to measure the effectiveness which the company uses assets to generate income. The higher it is, the more efficient the company is, since higher ratios mean the company generates more income per dollar of assets. That has been increasing as of late, kind of maintaining that 5.4, 5.5 level. But if it does jump up to this 5.8, 5.9, that will be the highest it's been since going all the way back to 2016. So that's why I'm saying it. You do have some positives here. You do have some negatives. Company paying out a dividend, they're not really showing much for 2023, but profitability stays strong. Again, we looked at the EPS forecast. They're basically at 2024 profitability back in 2022. So the company is technically ahead of schedule on the profitability side. And again, the revenue has been bouncing around, and even when they miss, it is very, very slight misses here. And now for 2023, expecting $28 billion. But again, last year, estimates were sub $26 billion. The company comes in with $27 billion. So, of course, only time will tell. But going down the road here, you can see up to 28.5, up to north of $29 billion, over $29.5 billion. So they're expecting like, what is that, like 2 or 3% revenue growth year over year moving forward, which I believe the company can do. Because, again, we looked at Q1 of 23 compared to Q1 of 22, and revenue was up 5%, and profitability was up roughly 20%. So, again, there is a lot going on. You do have some negatives. You do have great positives. Company's paying you a dividend. We can see here the debt, $4.3 billion, jumps up to almost $8 billion, starts to pull back 6.4, sub $6 billion, right? But, of course, again, cash flow has been suffering for the last couple of years, so, like they're trying to beat it up, but it really, technically, in my opinion, should be trading significantly higher than where it is right now. Assets still outweighing liabilities. We looked at that before. And again, in the technicals, I really don't see much going on here. I really don't. Again, we're in this downward trumpet, but, only time will tell. Again, I really do think this is a key level, and it's very, very hard for me to tell you guys where it's going to be in a couple of weeks or a couple of months because, again, I feel this drop shouldn't have even happened. And if they wanted to ride it along the bottom trend line, that would have been justified. But I really think they're just beating up these telecom companies, and they're trying to flush out all the stupid money, and then when it hits rock bottom, they're going to say how it's tremendously undervalued, and it's a staple in the society, and this is network infrastructure that's required, and then everyone and their brother is going to tell you that they stepped in, they bought shares, they're tucking it away, they think it's a great buy. And look at the forecast here again. This is one last thing I wanted to show you with the analyst here. And as you see here, out of 31 analysts, 20 of them give it a strong buy, 2 of them give it a buy. So out of 31 people asked, 22 of them say to buy it. and the last 9 say to hold it. See, so this is what I mean. This is why they'll try to beat a stock up in the long term, but if you supposedly, quote unquote, some of the best minds in the business, right, these top analysts at these financial institutions, you sit 31 of them down in a room, and they're all telling you to either buy it or hold it. So what would you do? Where do you think the stock is really going to go? They beat it up. One firm beats it up for the other firm for them to take a position, and then when they take profits, that's when the other firm steps in, and vice versa, and around and round we go. So like I said, we put 31 people in a room. They all say to buy or hold it, but you're going to bring it down as of late for a little bit of a drop on profitability? No way. Men lie, women lie, numbers do not lie. And again, I still believe that this company is tremendously undervalued. But it's just impossible to know, in my eyes, what's going to happen here in the short term. But we can try to come back to the company in a couple of weeks, or I can do a quick update video if it does begin to break down below this trend line into the 380s and the 370s and so on and so forth. Switching over here to stock charts very quickly, and then I'm going to let you go. But as you see here, RSI was really in the crapper here coming out after earnings down to about, I don't know, what's that, like 26, 27, and has basically been steadily climbing up, even though the company has been slowly stepping down. RSI sitting at 36.2, definitely has more room to run. The MACD crossed, and then you saw like the little rally here back above the mid-Bollinger Band, back into the low 4s, and then has leveled out. I really don't think this is going to cross back to the downside and take the stock with it. It really, really shouldn't, in my opinion. If it happens, of course, better buying opportunity, and it's definitely going to suck in the short term. But, either way, I really do still believe that this is going to work out. You had a sharp downtrend turn here on the MACD. This is going back, like April when they reported earnings. So now the MACD has been sliding. However, you can see right here at around this line is the lowest the MACD has been in several years, and we're almost approaching that line. That's why I'm saying the sell-off could potentially continue for a little bit, another 10, 15, 20 cents a share. We could slide down, but then in my eyes, it's only a matter of time before the MACD levels out at that line, and right here at that line, and then of course trends upward and crosses like it did on both occasions almost immediately after hitting that benchmark. So we're going to have to keep an eye on that as well. RSI on the weekly still sitting at around 36, nothing too crazy. However, I spoke about this last time, the divergence of these two moving averages here, 456 and 461. In my eyes, that's where the stock should be right now. That's where the company should be right now. There's really no reason as to why. And again, if we switch over here to the daily, you can see 50-day moving average 438, 200-day moving average 458. That's why I'm saying, in my eyes, the stock really fair valued, even if you want to keep it down, should be trading between like 440 and 460 a share. And then, of course, with a breakout quarter, I really see no reason as to why they don't pop it up into the 6s and the 7s. But I know this is a brand name stock that, again, a lot of people were keeping an eye on. A lot of people were looking for updates. And if you're a holder of the company, listen, it was a rough quarter for the stock. My apologies that the company did pull back down. However, like we always say, if we liked it and believed in it at 410, 440, 470, then we technically would like it even more down at $4. And you could essentially thank Wall Street for basically giving you a $6.5, $7, $8 stock on sale right now for sub $4, right? So that's why I always say, however dark the cloud, there's always a silver lining. And I know we get emotional because we work very hard for our money, but try to be very stoic when you look at your portfolio and when you analyze these charts, because I promise you, you getting stressed out or being emotionally tied to your assets and you can't afford to watch it go down, and oh my God, you're getting heart palpitations and the cold sweats. You have to stop all of that. You have to be a machine. You have to be a robot. Analyze the numbers, look at all the metrics, the RSIs, the MACDs, look at the charts, check tech patterns, everything. Everything I'm showing you guys that I do when you ask me about a company, you have to do that every single time. And if you're just buying something because it's popular, or you're stepping in on some naked calls because the company's posting earnings, it goes back to what I originally say. You are now gambling. You are not investing. Work smarter, not harder. But I'm going to end it there. So once again, Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up, algorithm, helps out the channel, helps me get more eyes on the channel. Subscribe to the channel if you're not already subscribed. I think, again, I have one of the better ratios on YouTube that I'm seeing. Even these channels that have hundreds of thousands and millions of subs are only receiving, I think it says like 7 to 10% of all viewers are subbed up to the channel. When I look at my analytics, roughly 18% of all viewers viewing these videos have already subbed up to the channel, and I think about 20% of the subs have notifications turned on. So a lot of these numbers, personally, for our channel here, it's just significantly above the norm. And obviously, that's all you guys. I have you guys to thank for that. So I appreciate the fact that you're subbing up, you appreciate the content, and more importantly, you want to be notified when I post a new video. It just means the world to me that you guys are, appreciating this content and really supporting me along the journey here. But moving forward, like I always say, I understand that markets are rocky and they're volatile and they're uncertain. So I want to wish everyone success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day. Stay positive. Catch you guys in the next one.